My name is Weston Weinberg. I'm here along with my co-hosts, Azaan Barlas and Jacie Cruz. Welcome to Top Down with TCM. Today we are speaking with Gabriel, Vendeth, and Jacie Chen. Jacie and Gabe, would you like to introduce yourself to the viewers?
So, hey everybody, I'm Gabriel. I am a portfolio manager, Titan Capital Management. I'm also a fixed income director of Smith. I'm also a research intern at Canterbury Consulting. I've been exploring different fields of finance and hoping to get a job soon.
Hello, everyone. My name is Jacie Chan, and I'm the fixed income portfolio manager for Titan Capital Management. I'm also the assistant director of the fixed income portfolio for Smith. Finance is a really interesting field since it's so broad. You can go into any subsectors you like. So I hope forward to meeting you all one day.
Yeah, and thank you for being here, Jacie and Gabe. So I want to start by asking, what have you learned about fixed income and bonds as a portfolio manager?
So fixed income, as Jacie mentioned before, it's basically a puzzle. There's a lot of moving pieces to it. You basically have to combine, all this information, usually from a top-down perspective. You start with the economy, and you kind of have this vision of your outlook going forward, and you tend to position the portfolio kind of how you see that going, right? And so you have sectors within fixed income that, just like equity, they're very specific. So, you have the investment grade corporates, you have the high yields, non-US, and they have varying degrees of risks and rewards, of course. When it comes to bonds, I learned that it's definitely more complicated, in my opinion, than what I knew about equity. And again, all goes back to the moving piece. A bond itself, you have to look at its maturity, its duration, its yield to worst, and you have to take all of that into account and how it'll impact the portfolio and how it will be impacted by outside sources, such as interest rates, for example. So again, it's you have to kind of take the whole thing and kind of narrow it down and go from there.
Okay. Interesting. So
Now,
I kind of wanted to add on to that question. So you said it's a little bit different than equity. So let's say I'm looking to buy let's say I'm looking to buy Disney as an equity versus a bond. What are the different things that I would look for in those two? Because from what I know from fixed income, if a company is doing well, is growing a lot, that's not necessarily a good buy for a bond. So how would you differentiate a buy for fixed income?
So, do you want to go, Jacie?
Sure. So for a buy for a fixed income, we look at the company's value, and then we also look at their free cash flows, where it determines if the company is able to pay you back.
So, as Jacie mentioned, you look at, so for fixed income, you don't necessarily care about the future value of the company, right? With equity, you're looking, usually it's a long-term view where you see a company and you're like, okay, Disney has a lot of growth potential going forward now because of Disney Plus and all their streaming services such as Hulu and ESPN Plus. And that's going to be a big thing going forward. They're basically going toe-to-toe with Netflix. And, once their parks open up, that's going to be another big deal. You kind of look at those things and you factor in, with the stock price and is it a good buy right now or not? But you're doing the fundamental analysis looking forward. Is this going to be a good company, right? Fixed income, you definitely want to look at the fundamentals of a company, but you don't necessarily care whether or not the company is going to grow. You kind of, as a bondholder, you just care about getting paid, right?
Yeah.
Because the company issued debt. So, are they going to be able to cover that? And so you can look at different ratios, evaluating their cash flows and their ability to pay the interest. And that's really, I guess, one of the key differentiators between when you're looking at a stock versus a bond. at the end of the day, you just want to get paid for the risk that you're taking.
Makes sense.
All right.
Now, I know, just to add on to that, like, I know that there's almost an opposite relationship between yield and price of a bond. So, when yield drops, price goes up. When price increases, yield drops. So what my question is, as a fixed income portfolio manager, are you chasing yield in the sense where you want the interest payout, or are you looking for the yield to drop so price can go up and you can sell that bond in a secondary market?
So I could touch a little bit on that, and if you want to add anything, Jacie, go for it. I think it's a balance between the two. Of course, it comes down to what the IPS of whatever the portfolio you're managing and the goals of the portfolio. But I think it's definitely a balance between the two. And like you said, that inverse relationship with interest rates is important. And then, you think of duration and all that other stuff that comes along with it. You definitely have to keep an eye on everything, especially when the economy is so crazy as it is right now.
Yeah, to add on to that, I feel like you shouldn't be chasing yield. So as a portfolio manager, you still have to look into durations. And basically for a bond portfolio manager, you're kind of one step ahead to prepare what's happening next instead of waiting there and to see what's going to happen, because that's how you're going to get hurt. So to be one step ahead as a bond portfolio manager, it's a better situation for you not to lose as much before it's too late.
Yeah, exactly. You want to be, proactive, not reactive. That's really important.
Okay. Cool. Thank you, guys. I'm going to jump in now with my question. And the subject I'm going to want to talk about is inflation. So we know what the Fed's quantitative easing with the Fed buying treasuries. And then there's going to be a proposed stimulus package within the trillions of dollars. A third one coming up. It's in the talks, not for sure. So with that in mind, that going on, I want to get your guys' opinion on how inflation will do within the next few years. I know the Fed's target's 2-3%, and they don't want to go anything over that, and they don't want to raise rates yet. So I just want to know, what are you guys' thoughts on that overall?
So, this is a big debate with, the money printer going burr.
Yeah.
So, I'm definitely not an expert on inflation and things of that nature, but I think it comes down to kind of how demand will be, right? There's a lot of people saying that's going to be pent up demand once COVID is over, and that's definitely a possibility. And the economy might be overheating. In the short term, I don't think inflation is going to jump very much. I think that demand is still suppressed, and it's going to stay that way until herd immunity is achieved at a global level. But I think in the next, 3 to 5 years, I think inflation could definitely start ramping up, and then that's when you see interest rate increases and things of that nature.
Well, I think with that question, I think what we are more interested in is how do you position your fixed income portfolio when there's the possibility of inflation, because it's not a hedge against inflation like equities and commodities are. It's a very different instrument. So let's say that inflation increases, the Fed's inflation target is about 2%. Let's say it increases 4% within 12 months. How does someone position their bond portfolio with inflation going up that much higher? Because wouldn't that have a big effect on the securities that you hold?
So there are securities that will protect you from inflation, such as TIPS.
Well, one way too is, like you mentioned, Weston, if it goes, above the Fed's target, I think that they'll definitely raise interest rates to kind of combat the overheating economy, because it's growing too fast. And one way to kind of position yourself better is to have a lower duration. So the duration is it's the impact of a change in interest rate on the price of a bond. And so the BAGS, or the Barclay Ag, is, I think it's like 6.1 duration. I believe the TCM bond portfolio is around 5-ish, 4.8 or something like that. If it's lower, it means that the change in a rising interest rate will impact the price of the bond less than the benchmark. So, if you have an increase of 1%, it's going to impact it. You can multiply the 1% times your duration. So it'll be, if the duration's 5, it'll drop the price of the bonds by 5%. That might be kind of complicated to explain that way without a drawing. Yeah. But it basically, you want the duration to be less if interest rates are rising, and that's one way you can position yourself.
Also, do not overweight in treasuries, because treasuries are heavily affected by the interest rates as they rise. So we want to overweight in either IG corps, lower grade IG corps or high yields, depending on their Moody Finch grade, investment grade.
Okay. Also, an additional question to that. Just curious, when is the best time to invest in higher yield, riskier bonds?
I think that's a good question. So I think it really depends. So right now, I think during a recession is probably the best time when spreads are wide to do so, but you have to be really picky about which companies you get, because, for example, back in March or April, that time, when the market crashed, spreads basically blew out, right? So then you have these companies that, at least if you're looking at the high yield sector, so they were already risky, and once the spreads widened so much, they became super risky. But that might just be a reaction of the market. The company itself might not have been heavily affected by the pandemic. Say it was some, I don't know, like a delivery company that wasn't doing too well. And, the pandemic came and they got a lot more business. Just because they were in a high yield, maybe that if you do a bottom up approach, that might mean that company is actually starting to do better now, even though they're in that high yield bracket. So you basically have to look for bargains, kind of the same thing you do with equities, really. But I think that's probably the best time, because when spreads start to kind of narrow, the price of the bond will go up. So that's one way you can kind of gain capital gains from. I don't know. What do you think, Jacie?
I agree as well. So when you have a tightened credit spread, it's really hard to get into the field because there's not much more you can go tighter. So basically, you're stuck at that same price probably until the next event happens where the credit spread tightens, and that's when you also get hit as well because your bond prices are dropping, and then you're just back to the same cycle again.
So for the viewers, can you explain what a credit spread is?
It's basically like the premium that you pay for the higher yield over treasuries. So if you have investment grade corporates, and let's just do an example for easy numbers. Say the treasury is yielding 10%, like a 10-year treasury, and 10-year investment grade corporate is yielding 5%. The spread would be 4%. It's just the difference between the two. So it gets kind of confusing, but that's essentially all it is. And then as you go to high yields, the spreads have to be higher or larger or wider, I guess you could say that way, because you're taking more risk and you have to get paid more for it. So whereas an investment grade corporate is less risky than a high yield, so the spread is wider. But that can vary by kind of, industry or sector. So it's not all the same.
So it shows the synonymous relationship between yield and risk, basically.
Yeah, exactly. As you take on more risk, you want kind of the yield to go up. It's because you want to get paid for taking that risk. So
True. I have another question if you guys don't have any right now.
Go for it.
So I just wanted to know if you guys have any opinions on like emerging market fixed income or like foreign bonds, because I know there's a lot of different opinions. Like let's say like bonds in China, a lot of people say, oh, China's a growing economy, so it's great to invest in them. But some people also say like they're not very trustable bonds because it's a lot riskier. So do you guys have any opinions or anything you've learned about the foreign exchange bond market, I guess?
I guess it's safer to purchase them as a funds. So funds, they'll do more research and pick the bonds that are where the bond investors are willing to pay for your yield instead of not paying for basically, if you purchase a bond fund, the bond fund managers will pick out the bonds that are trustable and reliable where they can pay back your the debt.
Okay.
As for if you choose them individually, you don't you do your research, but it's a lot of research, so the funds are easier to purchase as a whole.
Okay, so for like the everyday investor who wants to invest in foreign bonds, we should do it through a mutual fund, is what you're saying?
Yes.
Okay.
Do you agree on that, Gabe?
Yeah, I definitely agree with that. A mutual fund, or if you want, purchase it through the equity markets like a bond ETF that pays the dividend. So I definitely agree. I mean, it's kind of the same idea that, I think there's two reasons, right? If you're just a regular investor and you don't have a lot of capital to invest, but you want to invest in emerging market bonds or foreign debt, purchasing individual bonds is very expensive. It's not just foreign, but I guess just in general. Usually a bond will be like $1,000 in just one bond. So if you have $100,000 portfolio and you want to put 30% of that, the $30,000, you're better off putting that into funds, which will kind of diversify and spread the risk versus one or two bonds, that you have that 30 grand in. So that's like kind of, it makes a lot more sense. Bonds are expensive like that, usually because institutions buy them at a very large amount, like 5, 10, even 5-10 million plus transactions easily.
Mm-hmm.
So, the fund allows regular people to do that. And it kind of spreads the risk. But also, as Jacie mentioned, the fund manager, there's so many different kinds of funds that you can probably find one for your goal. They do have to do the research. And if a company defaults, you won't be necessarily out of the money on that, because you still have, hundreds of other bonds in that fund. So, I think for the regular investor, I think it's a lot better. You get more exposure and it's less risky.
I want to take a break from fixed income for a while and talk about the GameStop saga, the Reddit trader saga that has been going on the past week. And I want to talk about mainly the controversy behind Robinhood stopping trading and some brokerages stopping trading. We all know that hedge funds have lost a significant amount of money. And this is one of the times when retail traders have actually won, okay? I want to know what your guys' perspectives are in terms of whether that was correct. Like, was that right for them to do that? Or should it have been free? Because in my perspective, it's probably an unpopular opinion. But I thought that it was a way to protect retail traders from trading a stock that's, intrinsically worth like $3. That's probably what it was trading at for like years. Okay. And then suddenly it's at $3.50. So I want to hear your guys' thoughts on that.
You want to go first, Jacie? I feel like I've been talking a lot.
I'm an introvert.
Yeah, so am I.
No.
Okay. Yeah, I'll go first. I don't care. Okay, so you agree with Robinhood's action of limiting buying of GME and AMC and all those?
I'm gonna get roasted, but yes, I some part of me believes that it was protecting some traders that don't really know. They see the headline of GameStop going to like 160, and they're like, "Oh my God, let me invest my parents' life savings in the GameStop because it's gonna go to the moon."
Jason, you're basically that's the reason. Okay, for the viewer that's not aware, Jason is a socialist investor. He only buys ETF. So I would like the viewers to know that, just to preface what Jason's saying.
ETFs all the way. You'll see that in my personal podcast when these two interview me, but that's for another time. Anyway, what are your guys' opinions? I would love to hear them.
So, all right, go ahead, Jacie. Go ahead.
Okay. I feel like I'm like in the middle ground. Yes, I understand their intrinsic value is around $3, but as an investor, like personally for myself, like you have to give us a what's it called? You have to give investors warning to let them know that they can't. They're stopping the AMC and GME or any other retail stocks, because once the market opened and they figure that out, it's kind of like, why, like, you're stopping me? Like, this is a free market, and like their outrage of it, of course, because you, like, when the market opened, you just released that notice.
Yeah.
But
true.
I feel like they should have told them after market hours, oh, we're limiting to this amount, and then if that still, like, stock price still goes up, you can still like limit to a lower number instead of just completely halting it for a day when everyone's crazy because their outrage of not being able to buy the stocks. And they go to like Cash App. I know that they were using that. They were using they're just figuring out any way to basically overpower the retail investors because they're so outraged. I remember that day.
Yeah, big news. It really made big news.
I actually want to throw in my 2 cents real quick.
Let's hear it. Let's hear it.
Let's look at it this way, okay? Let's see Robinhood as someone that's representing a client, because your investors, the people that are trading on your platform, are your clients, right? It comes down to the relationship of, is it your job to protect your client or your job to do what the client wants you to do? That's the big relationship that there is right there. So when I see, at least because I, was in the mortgage industry, and if I'm like, hey, I can get you a 2.5% rate, and my client's like, no, I want a 3%, or I'll do business somewhere else. Like, no one would ever ask this, of course. I urge my client not to do that, but you have to give the client what the client wants. It's not you can give them all the information possible to protect them, but it's your job to represent your client and do what your client wants to do, whether it's an uninformed or bad decision. It does not matter. Like, I believe it's your fiduciary duty to do what your client wants rather than what you believe is best for your client.
Okay.
Weston, thank you for being a guest on our podcast.
Dude, I told you, I put in the chat, debate's happening.
I would like, okay, so yeah, I am on the other side of that, but I do understand that argument where it's like, it's a free market. It's your money. You can do whatever it is you want. I completely understand it, and I respect that. And I have nothing to go against it, but it's just like, at the same time, this could be something really irresponsible and it could hurt someone. So, yeah.
Gabe, what's your thoughts?
So, you know, it's an interesting situation. So my thoughts, I think I would actually side with Weston on this one, because it is a big thing. It's you get these irresponsible, uneducated people. They don't have a lot of experience in the financial industry, and they see the stock going up and they FOMO and they lose all their money, right? I think there was a guy who, I think his cost basis was like 1870 and AMC topped at like 20 something. And he went into surgery and then he woke up and he lost like 30 grand, right? That was really dumb. He's going to learn the hard way to never do that again without thinking.
Yeah.
And I think that's where it comes from. I've definitely fallen victim to FOMOs and I've lost money, but I've learned. And I think that's where a lot of people are going to learn. I don't think it's right for them to limit the stock because they initially said it wasn't a liquidity issue. And it definitely was if they had to get, more cash from their venture capitalist investors, right? I think Robinhood was in the wrong there. And, I think Webull and some other ones, because, Fidelity didn't limit that. Fidelity is a big boy, though. They know what they're doing. I think Robinhood just has a lot of kind of shady things happening. I think it's great that they democratized investing and basically forced all the big companies to, basically do free trading. I think that's great. But that's pretty much the only thing I like about Robinhood. I don't really like their app. I don't like how things work. So I guess I'm kind of biased here. But definitely if I had a big position and I couldn't, I guess they allowed you to sell, but if I wanted to do something else, that's not cool. So I don't think what they did was right.
All right.
I think that honestly, there should be a test before you open a brokerage account that just, if you can't pass like a basic financial, a test that just with basic, investment terms and kind of practices, if you can't do that, then you probably shouldn't invest in yourself. A lot of people are probably going to hate me for saying that, but I mean, if you knew the basics, you probably wouldn't have done that, at least without knowing the risk, right? Mm-hmm. I'm not saying you can't go out and put all of your life savings and, have diamond hands and, go to the moon. Go ahead and do that. I don't care, but know the risk. That's the main thing. So that's how I feel about it.
I could just imagine the question just being like, is it a wise idea to put $50,000 into GameStop? Is it? It's like...
it's interesting because it's like there's this conundrum where it's okay, you have the decision and then the outcome, right? Some people put $50,000, hundreds of $1,000s, right, into GameStop when the price was already high, right? That was probably a bad decision, but if they sold at like $400, it just so happens that it was a good outcome. Right?
Yeah.
So just because of this, the outcome was good doesn't make it a good decision. So you kind of have to think about that.
Yeah, absolutely. Azaan, I'm outgunned here. I think I'm 3-1 in this little debate here, but do you have any particular feelings on this issue? Just anything?
I mean, like, I probably agree with Jacie the most on this. Like, they should have gave a warning or if they actually had a liquidity issue, like there's literally nothing else they could have done. So like it makes sense, but like they didn't do it to like limit people. Like they didn't do it to help people, in my opinion. I don't think they did it to help people. Yep. So like giving anyone that one power, the government or whoever, like, oh, at the end of the day, they want to help someone. Like no one, like no business really wants to help someone if it hurts their bottom line. So I don't agree with like if they did, if we had 100% trust in them, then yeah, of course, but. Just let the people do what they want. Yeah.
Yeah, I mean, so I'm a glass half full kind of guy. So I'm just, I'm being nice because we can't say why Robinhood did it. Was it to help the hedge funds? Was it to protect the investors? We can't say why. So looking at it from, the clients that they're representing, which is their people, which is the retail investors trading on their platform, like I'm going to assume that they were doing it to protect them. Okay. And just looking at it from that standpoint, like it's your fiduciary duty to represent your client, even if what they're doing you disagree with, and you think that they should be making a better decision than that. You have to represent them. So I think we're all in about the same agreement, other than Jason. But yeah.
Yeah, no, I agree. Yeah.
Did you buy any GameStop? Is that why?
Did I? Absolutely not. That stock's worth garbage to me. Yeah, but it was very interesting just to see, everyone on the bandwagon. Like social media was flooded with GameStop. Twitter was flooded with GameStop. To the moon. Dogecoin. It was just like the field that we are in is like it's popular, like it's here, guys, and like I thought that was really interesting. I needed to talk about that while it was still relevant today. So
yeah,
I'm loving it. I love how this is exposing a ton of people to finance and to investing. I think it's great that it's becoming such a popular field, or just even like a hobby for a lot of people. And I think that's a really good thing overall, because it's sad to see people that don't invest their money and just keep their money in the bank account because, you're not utilizing it. Make decisions that you can use your money to make money, grow it over time. And I think it's really good to see that that it's being exposed to a lot more people.
Yeah, I agree. Just make sure you make an educated decision before you do anything. That's the main thing.
Agreed. I think that's all the time we have today, right?
Yeah, it is.
Yeah.
Yes.
But it was super cool to have you guys. This was like an amazing podcast. We learned a lot about fixed income and, of course, GameStop as well. But yeah, this was Top Down with TCM. Have a wonderful day, you guys.
Thank you.
Thank you.